As we start the new financial year, the Reserve Board met today and, as widely anticipated, they rinsed and repeated and kept the cash rate on hold at 1.5%. Now, what we are going to see, even though the cash rate is on hold, I still believe that over the course of the next few months, subject to what happens in the Royal Commission, that we are going to see banks lift their interest rates, okay? Because the cost of money is getting more expensive as we're seeing the US Fed Reserve lift their cash rate higher. So that cost of money is spreading around the globe. And so it's going to cost the banks a little bit more, and they're going to pass some of that on. So there is going to be obviously a PR challenge around that, and that's got everything to do with the Royal Commission. So just be mindful in your family budgets to start factoring in that we might be paying a little bit more for our interest on the repayments. Now, in a change of pace from my usual commentary around inflation, unemployment and so forth, I'm not going to do that because this last month, in middle of June, I heard a presentation from Governor Lowe, which I feel you absolutely need to listen to. Now, it does go for 25 minutes, but it is a really, really important 30,000 view foot in terms of looking down on Australia. And it focuses in on productivity, wages and overall prosperity for our nation. And I think there are a lot of good takeaways that government and also households need to start to understand in terms of what's happening in the macro economy that is Australia. You know, it's really important that you watch this video, and I want to highlight a couple of important points in there. Firstly, when we talk about wages growth. So we know that wages growth has been sluggish over the past couple of years. And what's interesting around this story is it's not necessarily repeating like it has in the past. And there's a couple of things that are going on here. Firstly, around competition. Okay, so we don't have that strong competition, which then pushes up, you know, competition for jobs, and we start to see that wage growth. But the other really critical thing is technology. So with the globalisation of technology, we're also seeing less demand for that human capital, and something needs to change there. So he explores that, and I think that's a really important part of his presentation in terms of how at the moment that we're not seeing that diffusion of that trickle down in terms of that innovation and technology coming down. So I want you to focus in on that because it does get a little bit technical, and then I'll finish with a wrap once you watch the video. So check it out, have a look at the graphs, understand the story that he's trying to tell, and we'll come back for a conclusion at the end.
I have participated in AI group events for many years, and I've always valued very much hearing from your members, so it's a real pleasure to be back here in Melbourne today. As Inna said, I've chosen as the title of my remarks today, or the title, Productivity, Wages and Prosperity. I know these three themes are important to members of the AI group, and they're also really important to the broader Australian community. I think, as Jeff said earlier, Australians enjoy a level of economic prosperity that few other people in the world enjoy. Per capita incomes here are high, and so is wealth per capita. We've also avoided bouts of high unemployment now for over a quarter of a century. Our banking system's strong. We have world-class natural resources, and Australians have access to high-quality healthcare and education. So there really is much for us to feel fortunate about. The question is, how do we sustain this prosperity? It's an important question to be asking. At the moment, there is unease in parts of the community about the future of work, about competition from overseas, and about the implications of technology. I know these are all issues that the members of the AI group are dealing with every single day. But for others in our community, these concerns are being brought into sharper focus over the last couple of years by unusually slow growth in nominal wages. As we address these important issues, we also need to keep focused on the critical task of raising national productivity, as Inna said. After all, lifting productivity is the key to building on our current prosperity and ensuring sustained growth in wages and incomes, and there are no shortage of good ideas here for us to pursue. My remarks this afternoon are going to be in four parts. First, I'll briefly cover the recent economic data, and then with that context, I'll talk about some of the reasons why wage growth has been as low as it has recently. I'll then turn to productivity growth, and finally I'll say a few words about the recent monetary policy decisions by the Reserve Bank Board. So first to the recent economic data. And last week's national accounts contained positive news about the Australian economy. As you can see here in this first chart, GDP rose by 3.1% over the year, and that outcome was stronger than we were expecting. The non-farm economy grew at 3.6% over the year, so that's quite strong growth. This outcome is consistent with the central scenario the Reserve Bank has had for some time, that this year and next the Australian economy would grow more quickly than it has over recent years. One particularly pleasing feature of the national accounts was the ongoing rise in investment. Non-mining business investment has increased by 10% over the past year, and you can see that on the left-hand side there. This lift is consistent with current business conditions, which, as measured by the AIG's own survey, are the highest level for many years. Investment is also being supported by increased spending on infrastructure, including in the areas of transport and renewable energy. So the investment story is a very positive one at the moment. One area that we continue to watch very carefully is consumption growth. Over the year, household consumption rose by 2.9%. That's a reasonable outcome, although growth in the March quarter was on the soft side. But over the year, stronger employment growth has contributed to a pickup in wage-related income, and this is helping support spending in the economy. At the same time, though, the level of household debt remains very high, and the housing markets in Sydney and Melbourne are both going through a period of adjustment after earlier very large price rises. And credit standards are also being tightened, so we're paying close attention to household finances at the moment. On the international front, the economic conditions remain pretty strong. The US and Japanese labour markets are quite tight, and Asia, including China, is benefiting from an upswing in trade and investment. At the same time, though, recent developments have increased some of the tail risks. One of these is political developments in Italy, which again have put the spotlight on the debt dynamics and the underlying intentions in the euro area. Another potential source of a financial shock is the increasing strains in several emerging market economies, including Argentina, Brazil and Turkey. And finally, there's the ongoing risk of an escalation in trade tensions sparked by the policies of the US administration. So against what is a reasonably positive international backdrop, these are some of the areas that we're currently watching. Excuse me. I would now like to turn to the issue that has attracted a lot of attention recently, and that is wages growth. Over recent times, wage growth in Australia around the 2% mark has become the norm. Some time back, the norm was more like 3 to 4%, and you can see the change in this chart. The downward shift in the rate of wage growth is clearly evident in the wage price index, as well as in the more volatile measure of average hourly earnings from the national accounts. And there are both cyclical and structural factors at work here. From the cyclical perspective, there is still a deal of spare capacity in our labour market. As you can see here, the unemployment rate has been around 5.5% for a year now. While we can't be definitive about what constitutes full employment, most conventional estimates for Australia are that it means an unemployment rate of around 5%. It is possible, though, that we could do better than this, especially if we approach the 5% mark at a steady pace rather than too quickly, as we're currently doing. Indeed, in a number of other countries, estimates of the unemployment rate associated with full employment are being revised lower as wage increases remain subdued in an environment where we have low unemployment rates. We have an open mind as to whether this might turn out to be the case in Australia too. I certainly hope it is. Time will tell, though. Broader measures of underutilisation suggest another source of spare capacity in the labour market. Currently, around 1/3 of workers work part-time, with most of these people happy to work part-time for personal reasons. However, of those working part-time, around 1/4 would like more hours than they currently do, and on average they would like to work an extra 2 days a week. If we account for this, these extra hours are equivalent to around 3% of the labour force. This suggests that the overall labour underutilisation rate is around 8.75% compared to the 5.5% traditional unemployment rate measured based on the number of unemployed people. Recent experience also reminds us of another important source of labour supply, and that's higher labour force participation, and Ines mentioned this. You can see the recent lift in labour force participation in this chart. As we've seen over recent times, when jobs are there, people stay in the workforce longer, and others who had not been looking for jobs start looking for jobs. So the supply side of our labour market is turning out to be quite flexible, even more so than we'd earlier thought. Another cyclical element that has affected average hourly earnings over recent years is the decline in very highly paid jobs in the resources sector as the mining boom came to an end. It looks, though, now that this compositional shift has worked its way through. So these various cyclical factors go some way to explaining the low wage growth over recent times. When there's spare capacity in the labour market, it's understandable that wage growth is slow. Yet alone, these cyclical factors don't fully explain what's going on. Some structural factors also appear to be at work, with perhaps the most important of these related to competition and technology, and I'll come back to this in a moment. The idea that structural factors are at work is supported by this next graph, which shows the wage price index and the responses to the NAB business survey, where firms are asked whether the availability of labour is a constraint on their current output. While there is still spare capacity in the labour market, firms are finding it more difficult to find suitable workers. Yet despite this, wage growth has not responded in the way that it once did. We see a similar pattern overseas. This next graph shows wage growth in the United States and the euro area, as well as survey-based measures of labour market tightness similar to the NAB survey that I showed for Australia. In both economies, wage growth has picked up in response to the tighter labour markets, but the response is not as large as it was in the past. We're still trying to fully understand why things in so many countries are turning out to be different to in the past and how persistent that will be. Part of the story is likely to be changes in the bargaining power of workers and an increased supply of workers as the global economy becomes increasingly integrated. But another important part of the story lies in the nature of recent technological progress. And there are a couple of aspects of this progress that I think are worth pointing out. The first is that it's heavily focused on software and information technology rather than installing new and better machines, or in other words, it's on intangible capital rather than physical capital. The second is that the dispersion of technology and productivity between leading and laggard firms has increased, perhaps because of the uneven ability of some firms to innovate and to use the new technologies. And the OECD has done some very interesting work documenting this increasing productivity gap. Both of these aspects of technology change are affecting wage dynamics, in my view. The returns to those who can develop and best use information technology have increased very strongly. These returns, though, are often highly concentrated in just a few firms and in only certain segments of the labour market. At the same time, the firms that are not able to innovate and take advantage of new technologies as quickly are slipping behind, and they feel under pressure, understandably. As a way of remaining competitive, many of these firms are responding by having a very, very strong focus on cost control. In many cases, this translates into a focus on controlling labour costs, because this is one thing they can control. And this cost control mentality does not make for an environment where firms are willing to pay larger wage increases. I think over time, we can expect the diffusion of new technology to take place. That's what the historical record suggests. I'm optimistic that this diffusion will boost aggregate productivity growth and will lift our real wages and our incomes. Advances in information technology, in artificial intelligence and in machine learning each have the potential to reshape our economies profoundly and to lift average living standards in ways that are difficult for us to envisage today. But the adoption and the diffusion of these new technologies is a gradual process. It takes time, it can take decades. And while it's taking place, the benefits of the new technologies are accruing unevenly across our community. And in my view, this is one of the key structural factors at work. Whatever weight one chooses to place on these various cyclical and structural factors, it's clear that slow wage growth is affecting our economy. On the positive side of the ledger, it's one of the factors that has helped boost employment growth over recent times. There are other factors at work as well, though. One is the low growth in wages is contributing to low rates of inflation in Australia. Indeed, if wage growth were to continue at around its current rate for an extended period, it's unlikely that the rate of inflation will average around the midpoint of the Reserve Bank's inflation target over the period ahead. Wage growth of 2% and reasonable labour productivity growth are unlikely to make for 2.5% inflation on a sustained basis. So that's an issue for us. Another consequence is that real debt burdens are higher and stay higher for longer. Many people who borrowed expected their incomes to grow at something like the old rate rather than the new rate of around 2%. With their expectations not being realised, the real value of debt stays higher for longer, and this is affecting people's spending decisions. And beyond these purely economic effects, the slow growth in wages is diminishing our sense of shared prosperity. If this remains the case, it can make needed economic reforms more difficult. Given these various effects, some pickup in wages growth would be a welcome development. It would help deliver a rate of inflation consistent with the target. It would help with the debt situation that we face, and it would add to our sense of shared prosperity. In my judgment, a return over time to a world where wage increases started with a 3 rather than a 2 is both possible and desirable. To be clear, this is not a call for a sudden jump in wages growth from the current rates to 3 point something. Rather, it will be better if this increase takes place gradually over time as the economy continues to improve. Encouragingly, there are some signs that we're starting to move in this direction, but I think it's going to be a gradual process. Labour markets in most parts of the country have tightened over the past year. One piece of evidence in support of this was in the graph that I showed earlier. There's been a sharp increase in the share of firms reporting the availability of labour as a constraint. The only other time in the past 25 years where this share has been as high as it currently is was in the early stages of the resources boom. And these survey results are consistent with what the RBA is hearing through our liaison program that Jeff mentioned earlier. One explanation for why firms are reporting that it's hard to find workers with the necessary skills is that the very high focus on cost control over recent years has led to reduced workplace training. And I think with the labour market now tightening, we're perhaps starting to pay the price for this. On a more positive note, a number of businesses and industry associations are now starting to address the skills shortages. And some businesses also tell us that another factor that has made it difficult to hire workers recently with the necessary skills is the tightening of visa requirements. It's reasonable to expect that as the labour market continues to tighten, wage growth will pick up. After all, the laws of supply and demand still work. Consistent with this, we hear reports through our liaison program of wages increasing more quickly in areas where there are capacity constraints, although these reports are still not very common. As part of our liaison program, we also ask firms about their expectations for wages growth over the next year, whether it will be lower, higher, or about the same as the past year. And the results are shown in this graph. There are now more firms expecting a pickup in wages growth and fewer firms expecting a decline compared with recent years, and I think this is good news. So it is reasonable to expect a pickup in wage growth from here. But to repeat the point, The pickup is expected to be only gradual, given both the spare capacity that still exists in our labour market and the various structural factors at work that I spoke of. So this is an appropriate segue into the issue of productivity. The best outcome is one where a pickup in wages growth is accompanied by stronger growth in labour productivity. That's because, ultimately, the basis for sustained growth in our living standards and wages is to become more productive as a nation. The recent productivity data, which I'm showing here, are difficult to interpret. Despite a positive outcome in the most recent quarter, there has been no net increase in measured labour productivity growth over the past 2 years. Over those 2 years, output growth has been subdued, but employment growth has been quite strong. In other words, measured labour productivity growth has been weak. However, if we take a slightly longer period, say since the end of 2010, labour productivity growth has been better, averaging around 1.4% per year, which I think is a reasonable estimate of the rate of productivity growth that we could expect over the medium term. The outcome over recent years has been boosted by strong productivity growth in the mining sector as new production comes on stream after the investment boom. It may be that the current lull in productivity growth is just noise in the data, and that's quite common. But it may also be a sign of something more persistent. If that turned out to be the case, it would be troubling. Again, time will tell. In trying to understand recent trends, it's also useful to examine what's been happening at the broad industry groups, goods-related industries, business services and household services, and you can see the different trends here. Employment growth has been especially strong in household services, yet measured productivity growth in this area of the economy has been quite weak. Output per hour worked in this set of industries is only 4% higher than it was in 2010. In contrast, over this period, output per hour worked is up between 13 and 16% in the other two industry groups, so it's quite a different picture. Almost 40% of the workforce currently work in household services. So the weak measured productivity growth here is weighing on outcomes for the economy as a whole. It's possible that part of the story is the difficulty of measuring output in some of these service industries. Even so, last year's Shifting the Dial report by the Productivity Commission highlighted some of the steps that we could take to boost productivity in our service industries. One of these steps is ensuring a strong focus on training, on education, and on the accumulation of human capital. As I've spoken about on previous occasions, our national comparative advantage will increasingly be built on the quality of our ideas and on our human capital. This means that a continued focus on education and research is critically important. An investment in human capital also helps with two of the other issues that I touched on earlier, the diffusion of new technologies and the emerging skill shortages. One explanation for the widening gap between the leading and the laggard firms is the difficulty of employing and developing new technologies. Successfully using these technologies requires both the right management capability and the right technical skills. Both of these can be difficult to acquire. It seems reasonable then to suggest that investment in human capital can both lift the rate of technical progress and accelerate its diffusion. It is therefore an important part of addressing the slow wage growth in many advanced economies, including Australia. And another way of encouraging the more rapid diffusion of technology is ensuring that there's strong competition in our markets and in our economy. There are many other elements of the productivity debate that are also important, and I don't plan to expand on them today, but the list I think is well known to you. It includes the design of the tax system, the provision and pricing of infrastructure, the way we finance innovation and new business, and our business culture around innovation, risk and entrepreneurship. We need to keep all these issues on the radar screens of both government and of business if we are to build the prosperity, or to build on the prosperity that we're currently enjoying. I'd like to close with just a few words on monetary policy. At its meeting last week, the Reserve Bank Board held the cash rate steady at 1.5%, where it's been since August 2016. Subsequent to the board meeting, the national accounts provided confirmation that the Australian economy is moving in the right direction. If this continues to be the case, it's likely that the next move in interest rates will be up and not down. It's however important to remember that the environment in which interest rates are increasing is also likely to be one in which people's incomes are growing more quickly than they currently are, and this will help with the adjustment. Any increase in interest rates, however, still looks to be some time off. The board will want to have reasonable confidence that inflation is picking up to be consistent with the medium-term target and that slack in the labour market is lessening. At this stage, a sustained pickup in inflation to around the midpoint of the target range is likely to require faster growth in wages than we're currently experiencing. There are reasonable grounds to expect that this increase in wage growth will occur, but for the reasons I've spoken about today, this increase is likely to be only gradual. Given this, there is not a strong case for a near-term adjustment in monetary policy. With things moving in the right direction, the board's view is that by holding rates steady, we can help promote a sense of stability and confidence in Australia. We hope that this helps Australians make the decisions that help build the future prosperity of the country that we're all so lucky to live in. Thank you very much for listening, and I'd be happy to answer some questions.
So there you have Governor Lowe's views around how he sees the broader macroeconomy. He made good indications there at the final piece around monetary policy. We also took obviously that deeper dive into the challenges around wage growth, inflation and also productivity. So if you cast your mind back to what happened in the early 1990s, we had this big problem around really high inflation, and we also had very poor productivity. Now, what the Keating government and the Hawke government of that era did was change everything around, and we did get really great outcomes in terms of human capital, and we also saw big increases in productivity, and that led to wage growth and prosperity. And you can see also that the Governor Lowe is also positive around how we might get through this period. So he's optimistic about what this will do, and the diffusion will flow down. Eventually that technology will be shared by all parties. So some really interesting information in there. You know, we have a very big agenda as a society, and also as our leaders sort of plan out the future of our economy. Our politicians get into the day-to-day arguments, and that's not great for us. Okay, we have a problem around government spending. We need to tighten that. We know we've got problems around, you know, sort of utility bills and how much it costs for heating and those types of things. We see the government trying to address that. We also know that our medical costs are also quite high as well. So they also need to be addressed. And I think technology will play a role in that in terms of hoping to bring those household costs down. Overall, I'm also very optimistic, but there's a big thing happening here. Globalisation, technology, those types of things. We still need to innovate. We still need to educate. We still need to look for those jobs of the future, because the world is changing. And that's why, you know, when we bring it back to our own personal circumstances as an investor, we're also focusing on where we buy properties, why we buy properties in those locations. We want high demand properties in good quality locations, and that's the important message here. So we are playing the long game when it comes to investing. So we want to be in marketplaces where there's lots of strong opportunities for education and jobs. That is an important part of this story as well. So, you know, this has been a change of pace. We have moved to a very long video, but I felt it was important at this moment in time that we address this story, because it is a very big story. We'll return to the data snapshots next month, but from this point of view, I'm glad that you've spent the time in taking over half an hour to watch this video, because you'll get a greater sense of what's happening in regards to the macro long-term prospects and prosperity of this country. Thanks for watching.